The topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Welcome to the Ask the Expert show on W4CY Radio and Talk4 TV, where we bring you educational information from top local experts in the fields of legal, health, financial, and home improvement. Now sit back and listen to experts in family law, association law, hearing loss, business brokers, home care, along with many other topics. Now here are your hosts, Steve-O and Sophia.
Hey, good morning. Hey, we're sorry about the late start today. It's live. This is live TV. Most shows out there are all pre-recorded and they can fix certain things. Well, our shows are live, and I want to welcome today to our show Alvin Clay. He has a company, wealth management company, and we're talking about money matters today. And we are so lucky to have the creme de la creme when it comes to wealth management. Good morning, Alvin.
Good morning, Steve. How are you? Looks like we were playing time zone musical chairs.
Crazy. Well, but we're here,
right.
And for the next 30 minutes, we are going to talk about money matters, wealth management. I have got some incredible questions for you. But before we start, we get so many new people joining the show every week. Tell people about your company and tell people about your background.
Well, my company is called Alvin Clay Financial Advisors. I paid a marketing guy big money to come up with that name. But frankly, we're used it because I say in all humility that my reputation was the most important thing. If I called it Jenkintown Financial Advisors, I don't think it would do much good. Prior to starting this business, I was the CEO of two different trust companies, larger trust companies. And when the last one was sold and I became a free agent, I decided to start my own business. Having put 7 kids through college and married off 4 daughters, I couldn't afford to retire. And so I set up this business, and it's wonderful because instead of managing a big business, I get to meet with individual clients, and that's what I really love to do. I'm a CPA. I have a master's degree in tax. I'm a certified financial planner and personal financial specialist. I got all the letters after my name, but I have a lot of experience in doing this, and I love doing it. I love sharing my experience with people and helping them solve their issues, and I get a real kick out of it when they, sometimes they think I did it for them, and all I really did is organize things for them and showed them that, and because they've been prudent their whole lives and haven't spent more than they earn, that they're not going to run out of money, and they think somehow I did it. Well, they did it by the way they lived. I just made them feel comfortable, about their choices. So it's a great business, and I love doing it. I'm about 100 yards from the church where I serve as deacon, so I can walk back and forth. And
nice.
Yeah, I'm a busy guy, but I love it.
Well, I got to tell you, we had a lot of questions in the last couple of weeks. People are concerned about these bank closings, what's happening with the economy. But it seems like, I guess the biggest question is, can you get your crystal ball out for the next 6 months to a year? And then we'll get into today's show.
Well, the way I want to respond to that is that if you need something for the next 6 months to the year, if your assets are that important, whatever assets are most important to you in the short term, you shouldn't be taking risk with them, or at least not substantial risk. So what I think is going to happen in the next 6 months to the year is almost irrelevant. What anybody thinks is going to happen. It's a long-term thing. And that sounds like it's just a packaged answer that we people who are in this business always say, but it's true. You know, when we manage money for people and set up their plan, the most important thing we do is get from them the information that we need to understand not only what they have, but for the future. I arrogantly say we're going to forecast the cash flow for the rest of your life. That we're going to say what's going to come in, what's going out, and when, and then how much money do you have? And what that tells us is when you will need to access your financial resources. And that is everything. Because if it's in the short term, I say this is a very sophisticated strategy. I have a bucket strategy. And the bucket strategy says in this bucket, we're going to put your short-term needs. And in this bucket, your midterm needs. And in this bucket, your long-term needs. And if your long-term needs are 10 years and out, you shouldn't care about the volatility in that because we've set aside funds for the short-term and intermediate. And you know, and that's why the next 6 months doesn't really matter. However, I will tell you what I hear, you know, and I'm not an expert in this. And if you have my TV behind me has the business channels on all the time, except when we're here, and you can get an expert to tell you both sides of the story all day long. But the consensus seems to be that there's going to be, you know, if there's going to be a recession, it's going to be a mild one. The issue of the national debt, quite frankly, or the debt ceiling, it will resolve itself. They're not going to default. They're just not. You know, the Republicans have already agreed to raise the debt limit, and they put conditions on it. You know, and the president says, I don't want any conditions. They'll work it out somehow, and there won't be a default on the national debt. That's too important. The more important issue over the long term is the national debt itself and how large it is. And what that's going to do to economies of the future. I don't think people should be worried about it, and hopefully that cooler heads prevail, and between McCarthy and President Biden, that they work something out that they both can save face. And,
Yes,
you know, because that becomes really important in politics. I hate it. You know,
so in your business, planning is so important.
It's everything. It's everything. It's a funny business in this. I have a confession to make. I get paid on the basis of the value of the assets that we manage. So essentially, we're getting paid for investment management, and then we throw in the planning for free. Well, that's bass backwards. All the values in the planning. The implementation of it, you know, you have to do it right, but that doesn't take any specific skill. Once the planning is done, anybody could sort of drop things into the right buckets, you know. But this is how the industry works, you know. And if you try to tell people I'm going to charge you for the planning and do the investments for free, they'll say, well, there's something wrong here. Doesn't matter. It's essentially the same amount of money you would get in either case. So the planning is everything because you know, what I tell people, and it's true at all time, and I have this handy dandy chart that I show with the history of the stock market. You know, I take it out and show it to them. But it has all of these charts on it, and they all look very different. The first one has all this volatility, and then the next one has less, and I said it's all got the same data in it, and the data is the history of the return on the U.S. stock market from 1872 to 2018. Why did they look very different? Because the first one measures returns 1 year at a time. The next one, 5 years. The next one, 10 years. The next one, 20 years. The 1 year one is really, really volatile. But the 5 and 10 and 20 are not so much. I said, so if you only got a statement every 5 years, you would think this is really boring. My account only ever goes up. But so if you can somehow parse out your assets so that you don't subject those things that you need soon to that volatility, and you understand that the long-term money, you can live with the volatility. I can't tell people not to open their statements, but
Yes,
if you only opened it every 5 or 10 years, you would be fine. You wouldn't worry. So, and when you explain it that way to people and demonstrate it to them, show them this is how we would do it, and this is why. And then what happens when you've had volatile times, or what we've had the last couple of years, I'll tell this honestly, I get almost no phone calls. You know, when the market dips like that, they don't call me, because I think they understand, and not only understand, but they also see that their short-term bucket's fine. So
you've educated your clients well.
Yeah, and that's what we do. You know, and it's all on the table. I have nothing, no reason to tell them anything other than what I really think. I could be wrong, but you're going to get what I think.
Well, I have got so many questions, Alvin. I want to start off is, what's the difference between a registered investment advisor and a broker?
It's almost sad that we have to ask that question, because most people have no idea, and it's this industry sort of writ large, this industry, financial services industry, has done this. At one time, there still is a real difference, but at one time it was registered investment advisors advise and get paid for their advice, and brokers sell investment products and get paid for selling investment products. And that's what the distinction is supposed to be. So I'm a registered investment advisor. I am not a broker. I don't have a securities license by design. I don't have an insurance sales license by design. And the reason I did that is that I want people to know that when I give advice as to whether I think they need to do something to their investments, whether they need more insurance, it's because I think that that's what they need, not because I sell it. I'm not going to get paid any more or less whether you follow my advice or not. If I was a broker, you know, I have an incentive for you to purchase this insurance product, the one that pays me the most. Now, I'm not saying these, or an investment product. I'm not saying these guys are dishonest. It's just it's a different relationship, and the people don't always understand the difference. So brokers get paid not for their advice. They get paid commissions on stock trades, which is very low these days. It used to, or almost nothing, but they do get commissions on mutual funds. They can put you in a mutual fund share class where they get a commission. If you borrow money from the brokerage firm on margin, they can make money. They make something on the margin loans. If you have a margin account with a brokerage firm, they can lend out your stock, and they can share in that. They can direct all of their trades to a specific a place and get paid for the order flow coming back. If they buy or sell bonds from the inventory of the brokerage firm, they can make a spread on it, and you don't even see that. I mean, they have to make money, but they're making money on transactions and activity all the time. And here's the problem. In this business, and if you said this is a registered investment advisor and this is a broker, this guy gets paid based on activity, this guy gets paid for his advice, you know the relationship. Like if you go to buy a car and the guy's going to get paid a commission on selling you the car, you know that in advance. So it's okay. He's going to tell you the best things about it, why it's great. If you buy a suit, the guy's going to tell you how good you look at it, you know, because but you don't think he's a liar. You know, you understand the relationship, and it's fine. And we need salespeople, and we need that. But what has happened now is, in my business, many people are dual registered. They are both a registered investment advisor and a broker. And they can almost literally at the same meeting, in the middle of the meeting, change hats. You know, and say, oh, I'm going to take off my investment advisor hat. I'm going to put on my broker hat or my insurance broker hat. That's a hard thing for people to accept or understand. So they think everybody's all the same. An advisor has a different standard of integrity, and we have a fiduciary standard where, you know, we are obligated, not only as a registered investment advisor, but for example, as a certified financial planner, we are required to do what's in the best interest of the client. And it's a higher standard than this product is suitable for the client. We need to know more about them. You know, we have to. So it's a difference. But the biggest difference is this: that registered investment advisors get paid for advice, and brokers get paid for investment products or insurance products, and that's not a bad thing. It's just a different thing, and that's the biggest difference.
Well, I got to tell you, I love your philosophy on your approach to giving investment advice. It makes so much sense, and you've been successful at it. Alvin, what about interest rates now? They're way up. What action should people be taking?
Well, it's kind of interesting because this is a new reality that came at us very, very quickly. We have been accustomed to near zero interest rates for so long now, and also low inflation for so long now. There are people who just didn't experience anything like this, who think that a 5% mortgage is outrageously high. Those of us who've been around for a while know that when I first bought my house, 5% would have been less than half the rate that I paid for my first house. But there's a couple of things. The fact is they are high. So assuming you have decisions to make, the very first thing that you should do, if you have high interest debt and you have the means to pay it off or some of it off, that's the first place to go. Because, or even if you're putting money away every week or every month, well, if you have high interest debt, don't put money away, pay off the debt, because you can have a credit card that has 23.99% interest. When you pay off debt, even partially, it's the same as investing your money at that rate. It is. It's the same
Makes
thing.
sense.
So you can't get 23.99 guaranteed anywhere in the world, even if it's lower interest debt, if it's 8, 9, 10%, and if you have the ability, pay that off first. Now, assuming that you've done that, the other thing you have to look at, and this is one thing that really frosts me. I see people come in, and with my clients, you almost never manage. I don't insist that we manage all of their money. They're going to have money in banks and things, and I'll look at, particularly in the large banks, they're very slow to catch up on paying people current market interest rates. They're paying 1.5%, 2%, 2.5% on deposits, and when they advertise a special rate of 4.5 or something like that in the fine print, it's only new money that's coming in from another bank. Now, you have people who, I won't name the banks, people who have been customers of these large banks for decades and decades. They can't move money from their checking account into a high interest account, one of these high interest accounts. No, that's only for new customers from new banks. It's crazy. So what I'm saying is, if you're going to keep some money in a bank, please look around, go on the internet, and you can get either a money market fund or it's a marketing thing, a money market account at a bank. A money market account at a bank is a bank account. The money market is just is a marketing way of saying we're competing with money market funds in terms of the rate. But you can move money very, very easily and quickly and safely and get more than the 1.5. I had somebody talk to me last week, and I was trying to tell them that to move money from one bank to another. I said, look, you go online and you can see 3, 4, 5 different places that you can move the money very safely. And they said, I don't do that. I don't do online stuff. And I said, you can send it here and I'll just put it in a money market for you. I said, here's the problem. I got to take a fee on that. And I finally said, well, look, if you won't do anything else and you'll send it here, you're still going to get a lot more than what you're getting now after my fee. But I can't just say I'm going to do it for free. I tried. I said, you could do it for nothing. You could go online and send it there. They said, oh, I don't do that. By the way, if they don't do that, they're probably not listening to this or watching this.
Yes. And it's usually an older demographic, isn't it?
Usually, but not always.
Okay.
I know octogenarians. In fact, what do you call someone who's over 90? Anyway, who use. I had one in the other day. He's online, and he drove here. He's 92. You know, and so yeah, it's usually an older characteristics, but not all. I've got a phone ringing here.
That's okay.
That's
Listen,
okay. If you can't hear it,
still
I
have
won't
your
worry
phone
about it.
ring. What about Alvin? What about a retired person owning stocks?
Well, what happens is that, and people will say that when you get to retirement age, that you shouldn't own stocks, or very many. And there were some old rules of thumb, like you should earn your age in bonds. Like if you're 65, you should be 65% in bonds and 35% in stocks. Well, I don't believe in any rules of thumb like that, because I don't care whether my client is 35 years old or 65 years old. We project what they're going to need and when they're going to need it. Because if you have money, if you're 65 years old and you have money that you know you will never ever touch, it's only there to be left to your heirs. Why do you have to worry about the volatility in that money? You know, why don't you invest it for growth? Because you're really looking at assume it's your children's money, essentially, who's young. And, you know, so that's one way. The other thing is that life expectancies are very long. And, you know, if you're 65 years old, you got a long way to go. You know, assuming your health is, even if you just live to the average life expectancy, you have a way to go, and you're going to need some growth in that portfolio as well. So if you look at the target date funds that from, you know, Vanguard or Fidelity or anybody else, when you reach 65, those funds are roughly 50% stocks and 50% bonds. So this is just, you know, Al Clay's opinion that the typical retiree should have a healthy allocation to the stock market, and that allocation to the stock market needs to be diversified. Large, small, growth, value, domestic, international. You really need to hold all of it. Unless you have a whole lot of money, that's got to be done using funds, because you're not going to be able to get that diversification buying individual stocks and having that make sense unless you have millions and millions of dollars to be able to do it. So, you know, when you retire, you're 65 years old, you need to be, well, everybody's a little different, you know, so the typical retiree should still have some exposure to stocks. That one thing that has happened recently, though, is that because bonds are now actually paying you something, people can feel a little bit better about moving a little bit more to bonds because they're getting 5% or something like that on it. And whereas, you know, a year and a half, they were getting nothing. You know, it's very difficult to allocate something to an asset class where you're not getting paid anything on it. You know, now at least if you want to be more conservative, you're not paying too much of a penalty for it.
You know, there's we just take for granted that people know what a stock is, what a bond is, a mutual fund, but not everybody knows that. And a lot of people are afraid to ask because they don't want to look like they're an idiot. So
yeah,
can you?
Well, that's right, and it's, you know, and it's such a shame, but it happens all the time. You know, so what I like to do, and I've done some teaching in my time, so. There's a way of doing this. You say to them, I know you know this, but let me just start with the simple, and then we'll get up to the more complex. And they never stop you. You know, they say, you know, go ahead. So it's important that you know what everything is, just the basics, because we make too many assumptions. Like we'll say, yes, you have an allocation to equities. And people think, okay, and they'll say, and they think equity, equal, fair. No, doesn't mean any of those things. So a stock, when you own a stock, you are an owner, a partial owner of a company. That's what a stock is. You have equity in that company, and equity in this sense is a financial term. You know, you think assets, things that you own, liabilities, things that you owe, and if your assets are higher than your liabilities, you have equity. Or as my dad, the accountant, used to say, if your liabilities get too high, your assets in jail. But so the stock is part ownership in a company, and if the company does well, it's going to be worth more because people will be willing to pay you more. And a dividend is a share of the profits of the company. So if the company's board of directors, who you had a hand in electing, decides to pay out some of the profits, that's what a dividend is. A bond, on the other hand, you don't own a piece of the company, you're lending the company some money, or you're lending the government some money, or the Turnpike Commission, or whoever it is. A bond is a loan, and you're the lender, and the issuer is the borrower. And a bond, has a face value on $1,000, and you lent them $1,000 when you bought that bond. Now, what happens with bonds? People say, well, they don't change up and down very much, but they do in terms of value. So what happened last year? There were bonds that were paying 2%. Well, all of a sudden, brand new bonds were paying 4%. Well, who's going to pay you $1,000 for your 2% bond when they can get a brand spanking new one that pays them 4%? So the value of the bonds went way down, which is what happened to Silicon Valley Bank. Mm-hmm. We're not going to go into that again, but that's what happened to them. Is they had all these long bonds, they didn't hedge them, the value of the bonds got down, and all of a sudden the bank is insolvent on a valuation measure. And a mutual fund is nothing but a bucket, an empty bucket in which you put stocks or bonds or both, and someone manages them. And it's a way for a retail investor to be able to have a diversified portfolio without having to buy each individual stock or each individual bond. I think
you make it so easy.
It's easy. And there are different kinds of mutual funds. You get into, there's 31 flavors of everything, but that's really it. A stock is ownership, bond, you're a lender, and a mutual fund is a bucket so that small investors can get diversified portfolios.
Well, I see why you used to teach. We are coming to the end of the show. It goes by so fast. Let's start off. Let's give everybody your phone number.
My phone number is 267-626-2382. 267-626-2382. Our website is alvinclay.com. I paid the marketer extra for that. And the email would be info@alvinclay.com.
Well, Alvin again will be with us again next month. Please send us your questions in 954-336-3767. Again, if you'd like to get a hold, reach Alvin 267-626-2382. Alvin, thank you so much.
Steve,
we'll see you next month. And we'll see you next week with more Ask the Experts. Have a good week, everybody.
Thanks for tuning in today to the Ask the Expert show on W4CY Radio and Talk4 TV. Tune in next week and every week to hear more from our experts on personal injury, insurance, air condition repairs, estate planning, Medicare, and many other topics in the areas of legal, health, financial, and home improvement. See you next week.